Yeah, well, to understand today's world of insurance and real estate, we have to go back to post-World War II America and look at a couple of huge mistakes that we made or that we've been in the process of making since then. And one is tens of millions of Americans have been moving to the Sun Belt, whether it's the Southwest in the U.S. or the East Coast in Hurricane Alley. And we weren't paying attention to the fact that natural disasters are frequent and cyclical in those places. You know, you have fires in Southern California and you have hurricanes in Florida and the rest of Hurricane Alley. And the more people we move there, the bigger the potential for disruption when these things hit. You know, Miami is guaranteed at some point in the future a direct hit from a Cat 5 hurricane, and it's going to be brutal when it happens. And these fires that keep happening in Southern California and the rest of the Southwest, those are things that are natural and recurring. Now, at the same time we've been moving all these people into dangerous places, we've been debasing the currency via excessively easy monetary policy. And that makes financial asset prices go up. And houses are basically financial assets because you borrow money to buy them in most cases. So home prices have been soaring at the same time that more and more people are moving into these dangerous places. And that puts the insurance companies in a big bind because they're on the hook for replacing these multi-million-dollar houses when they burn down or whether they're destroyed by a hurricane or whatever, which means they have to raise their premiums. And things are getting so bad now. And, you know, and I should say it's not because of climate change. It's not because any of these things are becoming more and more frequent. Necessarily. It's because people are moving into these places, which magnifies the danger and the cost of these recurring natural disasters. So yeah, the chart we have up now shows Miami's home prices. And you see that I'm eyeballing it, but it looks like they're about twice as high as they were at the peak of the real estate bubble in the 2000s. So you've got a massive amount of extremely expensive real estate right there, just waiting to be impaired and or destroyed by the next big hurricane. And with what's going on in Los Angeles right now, it's brutal. You know, they've got high winds, which are spreading fires. I'm not sure anything is still burning now, but they've been burning for the last couple of weeks. And they've got a record number of houses that have burned down. And it's not just, you know, one category of house. It's Pacific Palisades, which are extremely high priced, and other places which are more modest. They all burned down in the fires that just happened. And so what's happening with the insurance companies is that they're either raising their rates for homeowners insurance on both coasts to a level at which they can make money insuring all these incredibly expensive houses in places with frequent natural disasters, or they're just pulling out of those markets altogether. So they're leaving homeowners with a big problem in a lot of cases, where even if they can get homeowners insurance, it's so expensive that it's debilitating. They can't keep their house if they insure their house, or they can't get insurance at all, which means a lot of houses are uninsurable and therefore unsellable. And we're talking tens of thousands, if not hundreds of thousands of people on both coasts who are in this kind of a position where they've got extremely expensive real estate that they can't insure. And so if they want to get out of it, they can't sell it. But if they stay in it, they're on the hook for the whole price of the thing when the next natural disaster destroys it. Now, with all of that happening, you get something called the reverse wealth effect, which is the wealth effect is basically the process by which when our stocks go up, we feel rich and smart, and we're more likely to take a nice vacation or buy a Tesla or whatever, and that stimulates the economy. But the reverse happens when we feel poor and stupid, which is the way a growing number of homeowners on the coasts feel right now. And they, therefore, are a lot less likely to spend the way they would have otherwise, because they've got this giant gaping financial hole in their lives in the form of their house. And that could be enough to slow the economy down to tip us into recession in the next year. And we're so financially fragile because we've been borrowing so much money over the past 15 or so years to get us out of the Great Recession that a garden variety recession could easily metastasize into something much more dangerous. So it could well be that homeowners insurance is the catalyst that pushes us into a recession that then turns into something worse than the Great Recession of the previous decade. And who would have thought that homeowners insurance would be the catalyst? Because there are so many other things that seem more pressing, like us drifting into World War III, or inflation remaining ahead of the Fed's target range, forcing interest rates up. Those things seem like the more logical catalysts. But now, after the LA fires, it's completely possible that homeowners insurance in particular and real estate in general turn out to be the thing that pushes us into the next recession. The systemic financial collapse would happen like this. People are so traumatized by what's happening with their homeowners insurance that they pull back on spending. That slows the economy down, tips it into a recession. And there are so many over-leveraged sectors out there that a recession leads to a brutal equities bear market, maybe a banking crisis. You and I have talked quite a few times about commercial real estate tanking, especially office buildings, that impacts local and regional banks and leads to a run on the several thousand local and regional banks out there that hold a lot of commercial real estate paper. That forces the government to bail out this big sector, and then people see another multi-trillion-dollar bailout. And remember what happened in 2022 when inflation was almost double digits, or actually in real terms was definitely double digits. And then they act accordingly. They sell their bonds. They shift into real assets that causes inflation in that sector. And then this recession and bear market metastasize into something like the Great Depression, or something like the early stages of Weimar Germany, where government's bailing out everybody in sight with newly created currency, tanks the money, and drives everybody's cost of living up. That's when you get into really serious financial crisis territory, because it's not clear at that point what is the fix. If bailing everybody out makes the dollar tank, then how does the government fix that? They've got to raise interest rates to protect the dollar, but then that craters a bunch of other over-leveraged financial institutions, which forces another bailout. And at some point people just give up on the whole process. And I think that's what we're risking right now by borrowing as much money as we're borrowing. Government debt is going parabolic. It's straight up. September and October were the two biggest Septembers and Octobers for government debt ever. And this is not we're not at war or anything. We're not in any kind of a crisis. We're in, more or less peacetime. And we're still running these kinds of deficits. So we're taking ourselves in the direction of some kind of a gigantic financial crisis. And then, as we started this talk, it just becomes a question of what the catalyst is. And it could easily this time around be insurance.